There are a few great ways to invest your money. However, if you want the best returns, the stock market is a good option. If you do not already have stocks, you are missing out on something big. For a beginner, buying stocks can be overwhelming, and this book is meant to help you through the process. When you buy a stock, what you are basically doing is buying a part ownership of the company. You buy the stocks in individual shares. If you buy more shares, you get a greater stake in the company. Another thing, purchasing stocks can give you shareholder rights such as the right to vote and receive dividends. What is the importance of voting rights? The matter that shareholders vote on affect the value of the shares. Companies that are considered public are those that issue stocks because they give the public an opportunity to invest in them. Private companies, on the other hand, do not issue stocks on the public exchange. A company issues stocks to acquire capital. Once it issues stocks, it becomes accountable to its shareholders and has to adhere to strict disclosures and regulations. Stocks can earn you money in two ways. The first way is to buy stocks and resell them at a higher price. The number of shares you should buy depends on the amount of money you want to invest and the price of shares. The second way is to keep the shares and earn dividends. A dividend is a fraction of the company's earnings paid to shareholders. Stocks are traded on a public exchange. You can always get updated information on share prices of various companies. So how do you get those shares? You require a broker. This can be an online brokerage firm or an actual person. Investors nowadays prefer the latter. Stocks are issued in two forms: preferred stock and common stock. Common stock gives you ownership share in the company and it gives you voting rights. Preferred stock also gives you ownership share, but it gives you an entitlement to a predetermined dividend. Next, you need to decide the specific companies in which you want to invest. A lot of research is needed here. As a beginner, look for businesses that you understand. Those whose models you know well. If you are a tech person, it would be wise to invest in tech companies. Also, identify companies that have a solid competitive advantage and good management teams. Before you invest in a company, evaluate it by looking at the following: balance sheet, cash flow statement, income statement, earnings per share, price to earnings ratio, market capitalization, return on equity. Why choose stocks? Investing in bonds is safer than investing in stocks, so why take the risk? The stock market delivers much higher returns over time. Investing in stocks will see you grow your wealth efficiently and faster over time. The stock market is very volatile. However, as long as you are patient and have a long-term mindset, you will be fine. Smart way to invest in stocks: have a long-term mindset. Do not lose heart when the stock market falls. Diversify. Beginners should avoid penny stocks if you would like to cultivate a profitable investing style. Warren Buffett should be your role model. Although Buffett considered himself 85% Benjamin Graham while he was still a very active investor, his approach is more concentrated and qualitative than that of Graham. Graham went for average companies while Buffett prefers quality businesses. Buffett has a very simple formula: simple, not easy. There are 12 investing tenets that he likes to use. These tenets are categorized under value, management, business and financial measures. His tenets may sound easy and cliché, but executing them is not that easy. The Buffett method of investing can also be viewed as traditional and open to adaptation. His method is both flexible and successful. Most day traders seek to adhere to a strict formula and discipline, but successful investors are able to adapt their models according to changing situations. Buffett has a circle of competence that he adheres to, businesses that he understands and can analyze. According to him, if he understands a business deeply, he is in a better position to predict its future performance. How else can you project a business's performance if you do not understand it? First, understand and examine the business, not the investor sentiment, the economy or the market. Next, find a consistent operating history. Use the information that you have gathered to know whether the business has good long-term prospects. Buffett has 3 management tenets that he uses to evaluate the quality of management. This is one of the most difficult tasks for investors. Is the management rational? Asks Buffett. How wise is the management in terms of paying dividends to shareholders or reinvesting earnings? This question is very important. Research has shown that management can be greedy and reinvest profit in a quest to build empires as opposed to making good use of cash flow to maximize shareholder value. The other tenets seek to know how honest the management is with shareholders, whether or not it admits mistakes. Does the management resist a lust for activity and the duplication of competitor tactics and strategies? Instead of focusing on earnings per share, Buffett is more interested in return on equity (ROE). Debt-to-equity ratio leverage can distort ROE. Buffett is aware of this and chooses to analyze leverage separately. He prefers low-leverage companies. He also seeks high profit margins. Conclusion: Buffett looks at owners' earnings, that is, the cash flow that shareholders can access. As his third financial tenet, Buffett has what he calls a $1 premise. He asks, what is the market value of a dollar assigned to each dollar of retained earnings? Here, Warren estimates the intrinsic value of a company. He projects the earnings of the future owner, then he discounts them to the present. This will be easier if you apply the rest of Buffett's tenets. Buffett does not focus on short-term volatility of the market but rather has his eye on long-term returns. Buffett also came up with the word moat, which refers to something that gives a firm an advantage over other companies and protects against the competitors' incursions. He goes for companies that have a wide economic moat. If you don't find a way to make money while you sleep, you will work until you die. Warren Buffett.